So the British economy isn't doing well. In fact, it's stuck in economic stagnation. Growth throughout the years have been downright awful. We are talking about less than 0.5% quarter after quarter. And just like the US economy, the UK is being propped up by a ton of deficit spending, borrowing money to keep the wheels turning. And Labour is going to dig the country deeper into debt by doubling down on this playbook. Now, spending isn't necessarily bad, it's how the money is being allocated that's what matters. The UK just reviewed their budget, and Starmer's government is going to push spending to the next level. He's going to spend big. More money will be channeled into public services and more investments as well. But will this strategy work? We can contrast this with what China and the US are doing. Beijing is spending a ton on their industries like electric vehicles and semiconductors. The US is also throwing a ton of money on technology and green energy. The two biggest economies are allocating money to sectors of tomorrow, sectors where global demand for goods and services will be growing. Eventually, the world will spend money to buy US and Chinese goods, so external money will be flowing into their economies to grow it. So there is a fundamental difference here. The UK is going to ramp up spending over $90 billion annually over the next 5 years. So that's nearly $500 billion more. In addition, £100 billion will be spent over the next 5 years in the public sector. This is a double-edged sword that could backfire quite badly. The question we face is a simple one. Can this extra spending drive enough economic growth in the UK to make sense? Because it's clearly not sustainable for the long term. Most Western economies today, they are heavily saddled with debt, and if you spend money and it's not being done effectively, you'll only trigger a bigger inflation crisis down the road. And because the UK doesn't have the reserve currency, they can't borrow an infinite amount of money like the US. Neither can they monetize the debt and print money without huge consequences. For the next 5 years, the UK will be experiencing a huge increase in deficit spending. If we take all their expenses minus off government income, there will be a persistent shortfall. Every year, London will be facing a deficit of 20 to 40 billion pounds. This, of course, will be thrown onto the national debt pile. Increasing the debt burden is a very risky move. You have to pay the piper down the road eventually. Here's the issue. The market doesn't believe the UK can save their own economy. The yields of the 10-year gilt have exploded to the highest in a year. In December 2023, yields were only around 3.5%. Today, it's nearly 4.5%, 100 basis points higher. It's the same situation that happened to Liz Truss with her tax cuts. People believe it would lead to more inflation than economic growth. And this is very bad for the UK, whose economy is caught in perpetual stagnation. Bondholders like pension funds, they are losing a ton of money. But more importantly, the debt burden is going to rise to unsustainable levels. It pushes the UK closer towards the date of reckoning. The market as a whole doesn't believe the spending plan is going to work because it's essentially reallocating money from the private sector into public works. It's money going to transportation and the NHS, for example. Now, all these are very important for sure, but it doesn't solve the question of industry. Earlier in July, Labour declared the UK broke and broken, that the Tories left the economy in shambles. Now, that might be true, but it's imperative we look into the sectors of the UK economy that are crumbling. This chart shows us sectors with the highest number of bankruptcies in the first 5 months of 2023 and 2024. Construction, retail, auto repairs, restaurants, and manufacturing, these are the sectors with the most companies going bankrupt. The private sector is getting decimated thanks to high input costs and, of course, higher interest rates. So you can see this daily feedback loop being triggered by the new budget because Rachel Reeves, she wants to spend more but the market doesn't believe her. Interest rates have rebounded up. So if you're auto repair shop looking to expand or even just survive, getting a loan is going to be more expensive. Your cost goes up and the only solution left is to jack prices higher to the consumer or just go bankrupt yourself. And this is why fiscal spending has to be done very carefully, especially if your economy is fragile. You have very little wiggle room to maneuver around. Higher interest rates are a very big problem. It's not just your mortgage getting more expensive, it destroys small businesses across the country. In June, The UK had nearly 2,400 company failures, the third highest since the dot-com collapse. As interest rates climb higher and higher, UK companies are going to get squeezed. And if you think things can't get any worse, well, it actually can. To fund her spending plan, not all the money is coming from deficits. The tax burden on UK companies will be going up. There's a reason why the gilt market is selling down. Investors, they are betting that the budget just won't work. That is more of a stimulus push that will drive inflation up without increasing production. The public sector wins while the private sector stands to lose. Reeve's budget is going to increase spending from £26 billion this year to almost £80 billion by 2028. Extra taxes will also increase by nearly £40 billion. This is a net giveaway of £30 to £40 billion a year for the next half decade. So half of the new spending will be taxed into existence. Increasing taxes isn't a bad thing per se. It all depends on how effectively you spend it. If you can increase economic output like the supply of goods, then it's an overall boon. But personally, I'm quite skeptical here because it's being channeled directly into public services, and that may or may not help the British economy grow in the long term. But Starmer's gamble is a very big one. His tax hikes of £40 billion would be the biggest in history since 1993. It's equivalent to 1.25% of GDP, and that's a very big chunk of productive output that's being reallocated into the British economy. While it's true that there's chronic shortage of government investment, taxing productive parts of your economy to redistribute wealth isn't exactly ideal. And when we look into the details of the tax plan, we can identify the big gamble here. The brunt of the taxes will be borne by big companies and the rich. The UK is increasing the inheritance tax and wealthy foreigners earning money overseas. Capital gains tax is also increasing from 20 to 24%. So investments in the UK will get even more challenging. But big companies in the UK will get clobbered the most. National insurance or NI for employers will be going up by 1.2% to 15%. In addition, companies will have to start paying NI at lower income levels. Over the next 5 years, the UK expects to bring in over £100 billion from this new scheme, making the biggest companies in the UK pay for investments into public works. Once again, I have to emphasize that raising taxes or spending isn't per se the problem. The issue here is how the money will be spent and if the effects will be long-lasting. However, there are two big problems with this plan. Pushing money to public works is more of a sugar high. Yes, you are investing in the British economy, but will it be productive and create even more jobs? According to the OBR, this budget stimulus won't drive growth for long. In the immediate term, yes, GDP would fly up indeed. Labour's budget will increase GDP by 0.6% in 2025 and by 0.4% in 2026, but down the road the effects would collapse, and by 2030 the budget would result in a negative growth shock. And this is why we have a repudiation in the bond markets. Investors, they don't believe the UK can generate real economic growth to pay back their bonds without, and this is the big point, without devaluing the currency. But bond yields flying up would make the situation much worse. Businesses in the UK, big and small, will find it harder to borrow money and expand. So we could have a shrinking of the private sector for growth in the public sector. Is a very weird trade-off. And it's complete chaos in the UK Parliament because of this. Sunak himself is back for vengeance.
Today's budget sees the fiscal rules fiddled. Yeah. Borrowing increased by billions of pounds. Inflation-busting handouts for the trade unions. Britain's poorest pensioners squeezed. Yeah. Welfare spending out of control and a spree of tax rises they promised the working people of this country they would not do. National insurance, up. Capital gains tax, up. Inheritance tax, up. Energy taxes, up. Business rates, up. First-time buyer stamp duty, up. Pensions tax, up. They have fiddled the figures. They don't like it, Mr. Speaker. They don't like it, Madam Deputy Speaker.
Now, Sunak isn't the greatest PM in the world, we can all agree on that, but he does have a point here. The tax burden in the UK is rising higher and higher, and the further north it goes, the harder it is to do business in the country. Taxes in the UK will exceed 38% of the country's GDP, so over a third of economic output will come from taxes, and this would bring taxes to a historic high. It would be greater than in post-World War II. Even the United States is well below 30%, and that's saying something. And this makes it quite unthinkable to do business in the UK. Input costs are going up, and now taxes are going up as well. So there's enormous cost to Starmer's budget. It can't be raised solely by debt issuance because yields are just too high. But taxing your business base for 5 years could really make things even worse. Unlike the big powers that are self-sufficient, the UK has to bring investment into the country. They can't afford to deficit spend forever. Their consumer base is just too small to sustain their economy. Foreign direct investment into the UK have been stagnating. Since 2020, it has been less than $1.6 billion annually on average. The UK can't give massive subsidies to attract investments, and their current budget of tax increase could severely work against them. When companies want to invest in a country, they are looking for quite a few things. They want a low tax regime so that they can keep more profits, and that part should be very obvious. They also want to set up business in a country with a growing market, but UK consumers, they are becoming more and more tapped out, so that is a very big challenge as well. To make things worse, people's standard of living is expected to stagnate, and it should be quite obvious why. Raising taxes for companies could translate to smaller salary increases, while increased government spending could mean higher inflation, so you're being essentially squeezed from both ends of the spectrum. Real disposable income in the UK will grow by only 0.6% a year based on this budget plan. Sure, that's after you account for inflation, but it's still a horribly slow rise. And are the inflation metrics even accurate in the first place? Which also means consumption in the UK will be stagnant at best, so the big spending won't stimulate growth either. And as a foreign company, this isn't exactly a great endorsement to invest in the UK. And this reminds me of building a bridge to nowhere, shuffling the deck chairs on the Titanic and hoping for a big miracle. So Britain is caught in a terrible dilemma. They can't borrow anymore, especially when rates are exploding through the roof. And neither can they raise taxes without destroying the private sector further. But let me know what you think. Will the new British budget work? And how can the UK economy turn things around? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.